and drop just a quarter point by the end of 2025. Moody's Analytics chief economist Mark Zandi predicts rates, 30-year fixed mortgage rates now remain around 7%.
I mean, when Elon bought out Twitter and then went in and cut as drastically as he did, he proved, hey, this drastic reduction of headcount and ongoing operating expense can actually get you to a place of profitability.
Episode 20 of Market Moves with Mark and Jeff. Jeff, excited to be here with you today, talking a little bit more about real estate here. Doing business on hard mode, man. That's what it feels like these days. And I am just wrapping up my last Appraisal Institute board meeting last week. It's been a hectic couple of weeks here, trying to keep up with the pace of things. But it might be exciting to some to hear that that's my last board meeting and in volunteerism with the Appraisal Institute. At least for the foreseeable future. But, in and around all of that and the recent travel, boy, we thought we'd have certainty starting to hit home here with the election being decided one way or another. And, I think we've got a lot of reports that are coming out that are at least reporting on a really tough quarter three as we headed into the election. And what I think is pointing to a pretty tough quarter four. So, Jeff, two things that I saw here to kind of kick off the conversation. One was Opendoor announcing a $78 million Q3 loss. Good news. I think that was about a $35 million improvement in loss from Q3 of 2023. But in association with that loss, announced some layoffs, about 300 folks that will save them about $50 million next year, it looks like. So iBuyer business struggling. I saw similar struggles from OfferPad, who had bought 55% less homes in Q3 than the Q3 in the year before. And then we also had Rocket Mortgage that was reporting something like a $483 million loss. It's tough out there, Jeff.
People are losing money. I mean, what can you say? It's interesting to hear that OfferPad is losing market share while being profitable. I mean, maybe marginally so on the homes that they're selling, where Opendoor is interesting. It seems like it's losing money, but it's losing less money on bigger and while gaining market share, which is, maybe a little bit more of your traditional tech or startup trajectory of go in, try to disrupt a market, gain market share, taking a loss, and then pare back those losses as you build towards profitability. Interesting that, hey, those guys seem to be moving a direction that you would expect, but it's a tough market to be competing in out there, no doubt one way or the other.
I think the headline of Opendoor is I've looked into it a bit, is probably a little bit of like negativity clickbait and maybe not as indicative of the market going forward. They seem to be making improvement in efficiencies in the homes they're purchasing and turning that around. And I think both you and I believe that some sort of disruptive business model, like what these iBuyers are bringing, kind of making it like an e-transaction for the buyers and making it a real seamless process for a seller. A very complicated process to pretty seamless for a seller. I think there's room for that, but it is hard to innovate in our space. They seem to be making progress, and I'm excited for the changes that those things represent, because I think change could help.
Yeah, I totally agree, Mark. And I didn't have a front row seat to like an Uber, entrance into the marketplace or an Airbnb or something. I mean, I observed it, obviously, but it feels like this is maybe a little bit, on a similar trajectory there. The thing that these iBuyer programs offer are the convenience and ease to sell a home that you haven't traditionally had. When I got to go find an agent, I've got to market the home, I got a bunch of people coming through the home, I got to deal with offers and negotiation, and the buyer wants me to fix this stuff, or they want a bunch of concessions, and it's been traditionally kind of a cumbersome process. And so it's taking time, I think, for these guys to find a profitable foothold in the space, to disrupt the market in a way that becomes profitable. it's always hard to know if these type of initiatives fall flat or if they really, pick up a significant amount of market share. It's interesting to think about. You kind of take for granted, I show up anywhere in a city in the US and beyond, and I can just plan on getting an Uber somewhere. That wasn't the case, and probably wasn't all that long ago that it wasn't the case, from a historical perspective. Will this iBuyer thing become the new normal as far as how many people choose to buy and sell homes? I don't know. I could see that possibly being the case. It would certainly introduce a level of liquidity into the residential real estate market. If I can get an iBuyer offer and be sold and out of a home in a matter of days or a week, as opposed to the months that it typically will take to go list the home and get the offer and get it sold and closed and all of that sort of thing. It's just that aspect of it is really intriguing, to me. The speed and convenience that technology offers across the market, or the means by which it disrupts markets, it's fascinating. And maybe it falls flat for some reason, but I kind of would expect that this will become an increasing trend in the market.
Well, Jeff, if you talk to my wife, she might tell you that she thinks I'm cheap, and I think that the iBuyer is going to have a hard time reaching a seller like me that is cheap. Just as a for instance, I probably spent 30 hours selling a $3,000 car over the last 2 weeks on Auto Trader because I didn't want to take the $1,500 haircut at the dealership turning it in. And so I want to maximize whatever profitability I can for a whole variety of reasons. And so they may have a hard time getting at me because I'm not willing to pay a pretty hefty premium for that convenience. But I am not the majority of the marketplace, I don't think. So, yeah, I think there's a place for that. Looking at the $481 million loss from Rocket in the third quarter. I think this really starts to touch on the difficulties in our space. Appraisal companies, mortgage companies, banks, and so on. It is tough. My goodness. I think any group that has infrastructure like Rocket that is going through these still times, I think a lot of folks increased their infrastructure when Powell lowered those rates 50 basis points. Who wouldn't have assumed that rates would drop pretty materially when Powell lowered the Fed funds rate? The exact opposite happened, and not only that, in the most curious set of events, it now seems like the world is starting to shift to say, well, maybe 7% is all of 2025. And for those of us that have a lot of infrastructure in place, saw a very difficult Q3, almost certainly have a very difficult Q4 here. But then looking at 2025 and saying, man, the players on the field aren't going to change much in 2025. What are we looking at?
Yeah, so such an interesting thing, and I've heard the reference to a false start. I saw some people, advertising for new jobs in appraisal space, in lending space, expecting that with this beginning of a rate cut cycle from the Fed, and it wasn't just a single rate cut at a single meeting that was the expectation. That people were feeling like, all right, finally, we're at this tipping point where volumes are going to pick up. We're going to induce a bunch of buyers and market participants into the market because rates are now going to drop materially. And as you point out, they didn't. They went the opposite direction. And the other headlines I'm seeing and hearing are that there's a question as to whether the Fed even cuts in a December meeting or not. What is the expectation into 2025, as you're, I think, rightly pointing out? It's probably slower than what was just assumed to be the case 30 or 60 days ago, before this long anticipated rate cutting cycle that is not really resulting in lower rates materially, at least in the mortgage space for now.
It's just amazing, and so it just fascinates me that how unpredictable it has been. And I think we all knew that the Fed funds rate does not dictate the 30-year mortgage rate. But there's typically some level of correlation. I saw someone suggest that the last kind of major rate cuts from the Fed had mortgage rates go up for a period of time, 60 days, 45, 60, 90 days. I don't remember the time frame, but then start to come down below where they were when the rate cuts were announced. But since the 50 basis point drop, we've had a 25 basis point drop, and still really not much movement. Rates are sitting right at above 7%. And, as we look and see what the rest of the market is doing, we have Redfin projecting mortgage rates, had projected them at 6.1% for next year, 2025. They've since revised. They now are estimating 6.8%. This summary, by the way, taken from Mortgage Truth on Twitter, Colin Robertson. So thank you for that. Capital Economics, Thomas Ryan, expected rates to gradually drop. Now thinks they stay at 7%, and drop just a quarter point by the end of 2025. Moody's Analytics chief economist Mark Zandi predicts rates, 30-year fixed mortgage rates now remain around 7%. Boy, that is nasty. Just nasty. And I don't think a lot of folks saw this coming, and that may very well be the world we're living in.
It feels like a lot of these things happen in unpredictable ways. I mean, when the pandemic set on, I remember thinking, holy crap, this is going to be really painful. Nobody's going to buy, values are going to go down, business is going to be really slow. And then I look up, halfway into 2020, and things are, once the initial shock is over, there's tons of demand. And and part of that was, driven over the period of time by some of the government stimulus and some of the response to it to maybe prevent happening what could. But I'm less shocked at how often it seems like I should be shocked on some of these things where you expect things to go a certain direction, and then it turns out that they've gone, kind of the opposite direction. And that's definitely what's setting up here. So I wish I knew or had reason to hope for a significantly improved interest rate environment. But in the moment, the data on the field is suggesting that that's just not going to be the case.
So here, Jeff, hopefully I'm sharing correctly here live on the spot. But, so rates suck. I guess the headline from our really inspiring and optimistic podcast is they're going to suck for another year. Great. Well, I think what you hear from everybody is boy, are we about to get a home price collapse one way or another. And that certainly is logical to me. I mean, I have a very difficult time arguing against that on any level. But here we are from the St. Louis Fed's chart here on median sales price of houses. We have a Q2 2024 median sale price of $414, and we have a median sale price of $420,000 in Q3 of 2024. They have gone up, and I don't know what that percentage is, 1 or 2%, but they have risen. I've seen some other stats that I don't have easy access to right now that suggest something pretty similar. And they got to come down, right? That makes sense to me. But what I think people are choosing instead for now is don't do anything. Look, I'm not going to sacrifice the sale price here. I'm just going to sit and I'll just live in this house, even though I would have left under normal circumstances.
Yeah, that's exactly right. And we've touched a little bit on this affordable housing, issue and the pricing that's coming out. I saw a headline, that said something to the effect that people making $50,000 a year or less are really struggling with mortgage and rent payments. It's like, yeah, no kidding. Is that even like newsworthy at this point? But I'm seeing some other headlines and just some some data that's suggesting that everybody recognizes that there's an affordability issue. So long as people sit still and there's not additional inventory, brought to the market, it's kind of resulted in prices staying where they are. It doesn't seem sustainable to me as far as where things sit in the moment. A couple of things that are noteworthy are just some headlines that I've seen, Mark. One is new home starts were down in October. I think that data just dropped. Down 6.9%, so almost 7% from 970,000 starts in October. September was just over a million, 1.04 million was the number that I saw. As you remember, when we talked with Scott DiBiasio, he was talking about some of the candidates' policies, from the presidential election. Well, we now know who the president-elect is, but both of them were targeting 4 million affordable new homes coming onto the market into a presidency. These are total home starts that the home builders are talking about, and just a fraction of those would fit into that affordable space, it would seem. I saw another headline that was just interesting. We're not in Mexico and appraising or buying in Mexico, but evidently a similar affordability or housing affordability issue there. The incoming Mexican president, Claudia Sheinbaum, has an affordable housing initiative targeting 1 million new home starts in her incoming candidacy. And one of the interesting things there was that was also targeted in addition to a 0% mortgage on these homes. I don't have the details of exactly what that program would look like, but it just speaks to the need for affordable housing there as well as here. And if rates stay as high as they have been, as you're suggesting, it seems increasingly likely to me that, with kind of the tepid new home starts that seem to be coming onto the market, that you're going to have some give in home pricing as the alternative to the rates coming down to help address the affordability issue.
Boy, you bet. A myriad of problems in the real estate space, especially housing right now. And, typically we have home turnover rates of 5 to 6% of inventory per year, right? That is a typical, and recent turnover over the last little bit has been closer to 3%. And that's been going on for a couple of years now, maybe more. And so we have this, I think, pent up demand, unless Americans are throwing up their hands and saying, hey, moving up as life changes or moving down as life changes is just not really in the cards at this point. I'm going to keep my rate. I'm going to keep my payment and just sort of deal with whatever I've got now, because it is a better option than whatever I have in front of me. So, maybe we have some pent up demand, but what's going to release it? Maybe some economic confidence from certainty around the presidential election. It isn't going to be because of rates. It doesn't feel like. Or maybe, Jeff, we've got, maybe this is just what we need. Everybody finally giving up on rates being at some different level. And then they actually get to a lower level and people are somewhat surprised. And this is the first step to moving oneself away from rate shock that has had everybody sitting at such a standstill.
The psychology around interest rates is so interesting, Mark. People are always proud of like the interest rate that they got. I remember people telling me, I got a 2 point whatever or a 3 point whatever interest rate, as though like somebody had endowed them with, this like supernatural gift or something. And so I think you're exactly right. As you get a little bit away from this ultra focus or price sensitivity to the rate specifically, it probably is what's needed to move the mentality to the point where people say, hey, I've been putting off this change, this scale up, this scale down, or whatever, to actually pull the trigger on making a move. One other headline that I saw that would maybe support that idea just a little bit is the NAR's chief economist had predicted in 2025 sales transactions to increase by 11% over what they've been in 2024, and then was projecting another 6% increase into 2026. Now, of course, economic projections are hard to put too much stock in, but that the National Association of Realtors is expecting some level of just overall volume increases was interesting. And part of that projection was a 2% price increase over the next 2 years. Stay tuned to see whether that actually, plays out or not. But his comment, or one of his comments, was quoted as saying that maybe the worst is coming to an end. I think we're looking at this and saying, well, that may or may not hold true in terms of interest rates, and our outlook on those. But to the point that, as you say, the market starts to have some adoption of the new normal of interest rates. Maybe that unleashes a little bit of the pent up demand naturally.
Yeah, I think in the end, there are a lot of variables or factors that contribute to this psychology, but really in the end, what we are dealing with is interest rate shock. Yeah. That is what the American market participant in real estate is dealing with right now. They've got, they might have a great mortgage rate right now, which means a lower monthly rate, whatever. And so when this becomes a new normal and they're really, you start to forget what it was, and that this is more of a historical normal, maybe we get there. I don't know. And so, appraisers, real estate participants generally have been in this awful situation. I'll go to Las Vegas, Jeff, and, like, dang it, why are all of you people having so much fun? And how can you afford to go do this? rooting for bad news, rooting for people to not have money anymore to move about the country and celebrate, because for real estate participants, bad news is good news, right? We need the economy to hurt a little bit. And it's been sort of mystifying why it isn't hurting, despite a lot of pain that we see out there. And, I tie this to a pretty popular topic right now, which is DOGE, Department of Government Efficiency. For those of us that are close watchers of America's both balance sheet and P&L, it is very difficult to not be enormously concerned with our rate of spend, our rate of increase in spend. And, I've seen headlines of people quoting why interest rates aren't going down is because of inflation and the concern that we're just on this runaway train of running up the national deficit and just won't be able to rein it in. And so you have Trump getting elected. For those that watch the P&L, at least this aspect of his proposed policies is opening this Department of Government Efficiency run by Elon and Vivek. And, there's some certainly excitement from my standpoint in a watcher of America's balance sheet and P&L to say, hey, maybe this is an opportunity that I'm not sure how you could ever get to, a Javier Milei sort of situation in Argentina, that maybe you can actually make meaningful cuts to government spend and start to get the national debt and the U.S. balance sheet and P&L in a better condition. And so I think, there's some excitement when, this is actually going to be put in place, something I never would have thought would be possible. Okay, that's interesting. But then there's a real somber sort of realization that, well, what does this mean when we reduce government spending? It certainly means less government jobs. I think there's a pretty easy argument to make that government hiring has been lifting up surprisingly optimistic jobs reports over the last 2 years. And, does this mean bad news for the economy? Sort of short-term pain, short-term in the grand scheme of the U.S. history, and this government efficiency project where spending is cut.
Yeah, I'm glad you bring that up, Mark, and it ties in a little bit to even what the NAR's chief economist was talking about. That was one of the potential headwinds that he saw in his projection was, the ongoing federal deficit. He was quoted as saying will challenge the impact on housing for the next couple of years. And I think the way that he's getting there is saying that with concerns about a ballooning debt and deficit at the federal level, it becomes increasingly expensive and difficult to sell additional debt, from the feds as they try to borrow increasing amounts of money. And I don't know how this is going to play out. It's very interesting, whether you're rooting for it or against it, to see some of the players that are involved. I mean, when Elon bought out Twitter and then went in and cut as drastically as he did, he proved, hey, this drastic reduction of headcount and ongoing operating expense can actually get you to a place of profitability. But it was severe and significant. It wasn't just cutting at the margins. And, is there the ability and the political will? These aren't cabinet appointments. How much of what's being talked about can actually be implemented? I'm very interested to see, one way or the other. Is it a lot of talk about a little bit of cuts, or is it a lot of talk about, significant and a lot of cuts? Seeing Elon's track record, out there in the market, I would expect that as so long as there's the ability to enforce and actually do what he's talking about doing, it's probably going to be significant. And it probably what's needed to make a material difference. Will those type of deflationary actions and efforts offset some of the kind of known inflationary policies that the Trump administration is also talking about in, significantly increasing tariffs, tax cuts, those sorts of things? It remains to be seen, but I'm optimistic that at least there are some efforts both on the deflationary side of the equation as well as the inflationary side, as opposed to just this expectation that national policy is going to continue to lead to higher interest rates.
You bet. It is a fascinating experiment in my mind, and I've been so interested in what Argentina is doing in all of those, and I plan to kind of deep dive into it to understand it better, and maybe we can sort of have a veering off our traditional course, Jeff, and cover that a little bit in an upcoming episode, maybe even as a preparation for what we can expect over here in the States with this sort of stuff. But yeah, it's a really interesting topic, and I think all of these present very hard to predict circumstances for 2025. And I think for any that have large infrastructures in place, boy, that is a difficult prospect when coming out of what is likely a pretty difficult 2024. And we're seeing that from a lot of the Q3 earnings reports.
Yeah, absolutely. I do like your prospect maybe on site in Argentina.
There you go.
We would just have to multiply by 1 billion, I think, our viewership and subscribers to be able to justify something like that. Most may not know, probably don't, but I actually spent 2 years in Argentina. Now this was back kind of 99, 2000, 2001 era, but they had gone through a period leading up to that of hyperinflation, their value or their currency totally devalued, and then a reset. And what Milei is doing, through radical cuts and policy changes, as opposed to like this hard reset. I mean, I was young enough at the time, I didn't fully understand like all of the implications of what had led to their prior hyperinflation cycles. But it really is fascinating to see somebody say, here's my plan, I'm going to execute it, and then it starts to have the outcome that was promised or at least projected. And I think that very well could play out here as well if there is the political will and ability to act on some of these policies. But we'll have a front row seat, and I'd love to dive deeper into the Argentina experiment for sure.
Interesting stuff. Well, I think all of this discussion with the hard times and the headwinds that we're facing really highlight what you and I have covered over the last 2 episodes, sort of like such insulting timing on some level, with FHFA's announcement to reduce the amount of appraisal work available for appraisers. Just couldn't come at a worse time in the appraiser psyche that's out there. Yeah.
Absolutely right. These things, I think, start when times look different. By the time they get implemented, sometimes, they definitely don't. So yeah, I think there's more to come, on that waiver piece as well. So yeah, I'm interested to continue watching that.
Yeah. So Jeff, since we've posted our last episode with at Pinto on appraisal waivers, there's been sort of a joint trade association letter that is directed to FHFA being critical of the waiver expansion. Yeah. One of those reasons cited in that is that you're reducing the amount of work to us, and we like to make money and do work. And I thought that was a pretty weak, frankly, negotiating point. It feels sort of, I think it minimizes or diminishes all the other points because it feels self-dealing in some way that I am against these waiver things because you will be hurting my pocketbook. And, that just can't be a reason that appraisers or anyone are for or against something.
I think that's exactly right. And I think the reality on the ground is there are better reasons than that for the concern, around this policy and this rollout. And everything I listen to, including from those that are making some of the decisions at the GSEs, suggest that there's a need for certain skills that appraisers bring to the market. And I think as appraisers, we have to be focused on honing those skills and providing those skills to the marketplace. I mean, I talk about this all the time, but markets are, pretty rational. They're pretty unfeeling. I mean, they don't necessarily care about how you feel about something, but can I provide something in the market that's valuable that the market recognizes or not? And I think appraisers can. I mean, I think that there is a role far into the future that appraisers can fill in the valuation space, but it's that skill of being able to assess the market, read what it's demanding, from a market participant, and then be able to meet that need in the market that we just have to be good at, not just in determining what the value of a home is in a market, but what's the value of an appraisal or valuation service, in that market as well.
You bet. Well, so in our first episode regarding or covering appraisal waivers, we just kind of off the cuff perspective of the announcement. We then learned a little more about appraisal waivers, certainly from a maybe an opposing view of them with Ed Pinto from American Enterprise Institute. And I think we have locked in for an upcoming episode an interview with Freddie Mac and a team member from Freddie to talk about the waivers from their perspective to the extent they can. So be a good, I presume they'll generally be for the waivers. I don't know that, but we'll kind of cover that from all three angles here, and hopefully we'll help further our understanding of the process and how each of the parties, those opposing, those for, those implementing, view it, so that we can kind of be better and react and figure out how to operate within the marketplace in this new world.
Yeah, I love that perspective. And I think it speaks to kind of the ethos of what we want to be with this, Market Moves podcast of let's assess the truth on the ground as it is. And as with any truth, there are multiple perspectives and angles that, that come to, how things come about, the way that they have. And so, let's honestly assess what's out there. And then, people can obviously make their decisions and react, accordingly. But I like this approach of let's try to understand it from as many different, angles as possible. I did have the thought that it's just interesting with this increased loan to value ratio aspect, on which waivers and inspection-based waivers are offered. At some point, you start to get into like mortgage insurance, aspects as well. And I don't know, if there's an angle there, or, if mortgage insurance companies have a perspective on these. Are they fully on board and happy with whatever Fannie and Freddie policies are? Are they not? That may be something we could dive into as well in a future episode, Mark.
Boy, I'll tell you what, Jeff, if I had a nickel for every time a lender told me they can't do something because their investors won't allow them to do it. And it's always just a dead conversation, because I can't talk to those investors or secondary market participants. And yeah, I think the mortgage insurance is certainly like that too. They what they say goes in large part. And be interesting to see. I mean, I think, the gaming of the system that Ed brought to light, skipping of an appraisal and using the alternative methods has the potential for risk. Fighting a cold here, so excuse me for that. And but Jeff, I think just a wildly changing landscape. Covered artificial intelligence a few episodes ago too. I am weekly taking in new data and new content and new ideas, getting glimpses of what some of my peers in the marketplace are doing with artificial intelligence, and thinking a lot about it myself. I mean, you talk about this unknown landscape of rates, waivers. There is just DOGE. There are so many things out in front of us here.
Well, I think one of the characteristics that makes a good appraiser or any market participant is just curiosity and interest in what's happening. And the landscape is changing rapidly. That's probably always been the case, but I think technology facilitates the rate of change. Certainly artificial intelligence is going to. I think about when it rolled out, well, I mean, it depending on how you define it, but when I think about like ChatGPT specifically, hitting the stage and just the conversations and rapid rate of evolution there, it's crazy to think it was fall of 2022, I think, that ChatGPT hit the stage. And it's that and similar, large language models are really changing the landscape. I think their capacity probably outpaces our ability to adopt and integrate, what some of that capacity is, while the capacity is changing rapidly. But these things all are interesting. It's fun to have a front row seat to a lot of these things taking place in the market, and we'll continue to observe and pursue intellectual curiosities on them.
Yeah, Jeff, I think my closing thoughts are that, we will look back and see that we are living in a wild transition in human history, maybe even in U.S. history, but it will have meant that we are doing business on hard mode right now in trying to figure out where we fit in well and where this market is going.
Absolutely. I wish there was extra credit or something for doing business on hard mode. I think the outcome is simply that you have the privilege to survive and fight another day. But, we'll be here to observe it as we go. And I look forward to it, Mark.
Market Moves, man in the arena, doing work out there. I know all of you listening are doing the same thing. Keep fighting the good fight until episode 21.
Till next time.